In this video, we're going to talk about financial risk, diversification, a way of trying to reduce the risk by not putting all your eggs in one basket, and we're also going to talk about CAPM, or the Capital Asset Pricing Model. Welcome to My Finance Teacher. In the modern informational world, we are bombarded with news every single day, and clearly the news, be that economic, financial, or geopolitical news, clearly those do affect our general stock market. But if you look at the particular details, for example, let's look at this chart. This is S&P 500. Over here, this big green bar at the low in February, that's actually on the 24th of February. That's when the news broke over Russian invasion. How come at the time when the news broke, the stock market has actually rallied for nearly a week after that? Well, the thing is, this news was actually expected, and in expectation of this bad news, stock markets had been declining for a few weeks prior. In reality, not all news are the same. We can break them up into unexpected news and expected news. Expected news, as here on the day of invasion, aren't actually going to affect the market because their effect on the market had already been priced in during that expectation period of this news actually coming out. It's only the unexpected news that is going to affect the market on the day of its announcement. And because any unexpected news is uncertain, one of a theory of stock market volatility states that the changes in stock market prices are random and are impossible to predict. And as the news are split into expected and unexpected, so is the return. The total return on a portfolio consists of some expected component and unexpected returns, which is a bit like the risky part of the portfolio, as this unexpected return can also be negative. And the unexpected returns themselves can be split into either systematic risk or unsystematic risk. Systematic risk is the sort of risk that affects the whole market, such as, for example, the global financial crisis. During the global financial crisis of 2008-2009, the whole stock market went down regardless of whether investors were in tech companies or in retail businesses, in transportation businesses or in real estate businesses. Everything generally went down, and that is a really good example of systematic risk. Unsystematic risk is a risk that is asset specific to a particular company. For example, if you invest into one particular company only, say Tesla, and it ends up being involved in some sort of a scandal, that would be an unsystematic risk specific to this one company. And the good news here in relation to unsystematic risk is that diversification can actually help us reduce that unsystematic risk. Why would you invest all of your portfolio, all of your investable assets into one company, even as big as Tesla? Why would you put all of your eggs in one basket? Instead, diversifying, spreading the investment portfolio across different assets can reduce that unsystematic risk. But there is a limit to how much risk reduction you can achieve through diversification, because even if you invest into a large bunch of different companies in different industries, different commodities, if there is a systematic risk, such as during the global financial crisis, everything is likely to be affected negatively. So diversification reduces the unsystematic risk all the way down to the level of systematic risk. That's the minimum level of risk even a well-diversified portfolio will still have. And as I mentioned in a recent video, due to this diversification process, portfolio risk, as measured, say, by standard deviation or variance, is lower than the weighted average risk of individual stocks that are the components of this particular portfolio. For more details on calculating portfolio variance and standard deviation, check the link down in the description and at the top of the screen right now. Now think about it. If unsystematic risk is relatively easy to eliminate with a well-diversified portfolio, then a competitive market would not really provide any reward for taking on that unnecessary risk. On the other hand, we have learned from one of the older videos that there is a relationship between risk and reward. So to clarify that, we are learning now that risk does come with a reward of expected returns. However, this reward only covers the systematic risk, and no reward is provided for taking on unnecessary unsystematic risk. So let's have a look at this example. Remember, standard deviation from that recent video is one kind of a measure for risk. It actually measures the total risk, both systematic and unsystematic risk, of a standalone asset, of a standalone stock or a company share. The measurement for systematic part of the risk is called beta, and actually it measures volatility of the asset price relative to market volatility. So if the whole stock market, due to some systematic risks actually playing out, goes down by say 10%, if this particular stock price goes down by 20%, that is the double of the market volatility. In that case, the measurement, the beta, is going to be equal to 2. Now remember, it's only systematic risk that is rewarded with positive expected returns. So looking at this example of two companies, say Tesla and Apple, say we have a measurement of total risk of 0.2 for Tesla and 0.3 for Apple, and the measurement of beta of 1.25 for Tesla and 0.95 for Apple. Standard deviation is larger for Apple. The total risk is larger for Apple. Which of these two companies is going to have a greater expected returns? Well, despite the total standalone risk being higher for Apple, much of this risk, the unsystematic part of this risk, is not really necessary to hold on to. It can be easily eliminated with a well-diversified portfolio, so it's only the systematic part of the risk, as measured by beta, that is rewarded with expected returns. So in answer to this question, it's actually Tesla that is going to have a greater expected return in this particular example. We can actually visualize this positive relationship between beta, the measurement of risk, and expected returns. And that actually brings us to CAPM, the capital asset pricing model. Let's have expected returns on the vertical axis and beta, the measurement for systematic risk, on the horizontal axis. Let's start with this level of zero systematic risk. If there is no systematic risk at all, would the investor be eligible to expect any kind of return? And the answer is yes. Even if there is no systematic risk, the investor would still like to get some return. Otherwise, why investing? And that expected return would be called risk-free return or risk-free rate of return. And the example often used in finance is the return you can get on short-term government bonds or on short-term T-bills. The argument is that even if the government is struggling to raise money, they can always print more money to pay at least some of their short-term debts. And to look at some outlandish risks out there, perhaps longer-term bonds are risky in case of, say, a Martian invasion, but such outlandish risks of Martian invasion are highly unlikely over the period of a shorter-term bonds or the T-bills. So to start, we can illustrate this positive relationship between expected return and beta, starting from this risk-free rate of return and go into a positively sloped straight line. That is actually an illustration of the capital asset pricing model. And in the form of an equation, the capital asset pricing model states what is the expected return for any asset with a given level of beta, given level of systematic risk. And the slope of this line, that is a security market line, SML, is determined by the reward to risk ratio, the amount of additional return on top of the risk-free rate of return for investing into an asset with given level of beta. So for the beta level X, the expected return is going to be equal to this level of expected return Rx. And in this case, the risk premium is the additional return within this expected return on top of the risk-free rate of return. So the slope in this example, which is rise over run, is equal to this rise, the difference between expected return on asset X and the risk-free rate of return, divided by this run, or the beta of this asset X. That is the compensation for holding risk with this asset X. And in market equilibrium, this compensation is going to be more or less the same for all different assets, for all different stocks. So the unit of reward per unit of risk will tend to equalize across, say, Tesla, Apple, and the general stock market itself, say S&P 500, which has a beta of 1. That is, the general stock market is perfectly correlated to the general stock market. And the additional return on the general stock market on top of the risk-free rate of return is the market risk premium. And in the longer term, in equilibriums, different assets will tend to align along this securities market line. And here's the intuition. Say we have Apple somewhere here, pretty high above the securities market line, and say we have Tesla somewhere here, quite a bit lower below that securities market line. What it means is that while the beta for Apple is relatively low, the risks of investing into Apple are relatively low, the expected returns are pretty high. That will create a lot of demand for Apple shares, and a rising demand for Apple shares will increase the stock price. And a higher stock price with the given guidelines for annual earnings will mean that the expected returns will start to decline. For example, say the guidelines for earnings is $20 per share, but the share price is rising. That will reduce your expected return, bringing this Apple stock closer to this security market line. Something similar is going to happen to Tesla. The risks are relatively high as beta is pretty high, but the returns are very low. That will create a lot of supply of Tesla stocks. A lot of investors holding Tesla will want to move into another asset, selling this stock and depressing the price. Price drops significantly, and for given earnings expectations, lower price means expected returns are higher, bringing Tesla closer again to this securities market line. This is what you would expect in the longer term equilibrium. But in the meantime, in the short term, when Apple is far above the securities market line, it is underpriced, and high demand for Apple stocks, increasing the price and reducing expected returns, will bring this stock from underpriced closer to fairly priced near the securities market line. The opposite is true with Tesla, which is overpriced. At this high price, the returns are very low. A lot of investors keep selling Tesla stock when the price drops until it turns from being overpriced somewhere closer to fairly priced and a better expected return at a much lower price levels. And of course, as I often mention in a lot of my videos, especially related to gold miners, as investors what we try to do is try to find underpriced assets with relatively attractive returns before the rest of the market brings the price higher, closer to the equilibrium, at the equilibrium expected returns for the given level of risk. So all of this area above the securities market line is actually the area where stocks will be underpriced, whereas all of this area below is the area where the stocks will be overvalued or overpriced. And lastly, from the securities market line, we can move on to the capital asset pricing model, which states that the expected rate of return on an asset I, ERI, is equal to the risk-free rate of return, which the investor would expect to get even without taking any risk, plus the difference between expected market rate of return and the risk-free rate of return multiplied by beta. Why multiplied by beta? That's because the difference between the expected market rate of return and risk-free rate of return, that's the risk premium on holding the market, that's the additional compensation for holding risk, that is risk premium, per unit of beta, per 1, as market has the beta of 1, multiplied by the beta of the stock that the investor is holding, which shows the number of units of that systematic risk. Another way to write this formula is the risk-free rate of return plus the market risk premium, this difference in the brackets in the top, multiplied by beta. And to understand this a little bit clearly, let's have a couple of examples. Say, for example, the risk-free rate of return on short-term government bonds is 2.1%. Say the market expected return is 6.8%. And we have two companies here, Newmont and Nvidia, with the beta of 0.9 and 1.2. What are the expected returns on these two companies? According to the model, according to the capital asset pricing model, it should be equal to the risk-free rate of return plus the market risk premium, which is the difference between market expected return and the market risk premium, multiplied by beta, the level of systematic risk. That gives us an expected rate of return according to CAPM, or the required rate of return for Newmont, of 6.33%. And for NVIDIA, again, the risk-free rate of return plus the difference between the market rate of return and the risk-free rate of return multiplied by its beta gives us the expected rate of return according to the model, or the required rate of return, of 7.74%. And if the current rates of return on these two companies is 9% and 6%, we can place these two on the chart for the securities market line with NEM relatively high expected rate of return, meaning that Newmont is undervalued. The price is expected to rise to bring the expected rate of return back down to the market equilibrium from 9% down to 6.3%. And NVIDIA is overvalued with expected rate of return pretty low. And as it's overvalued, price should decline, raising the returns closer to the securities market line, up from current 6%, somewhere closer to 7.7%. So again, NEM is undervalued in this case, and NVIDIA is overvalued in this case. And similarly, if instead of the expected market rate of return, we knew the market risk premium, which is same as this difference of 4.7%, we could calculate the expected returns by using the market risk premium instead of a slightly longer formula. And as I'm changing the reference here, you see that the answer stays the same. So in summary, that's our capital asset pricing model, which shows our required rate of return for a given asset or a given level of systematic risk, and the illustration of this capital asset pricing model with a securities market line. I hope this helps, and remember that hitting the like button brings you luck on the exams. Bye-bye.